Well, good morning, everybody. This is Seth Martin. Welcome to Middle Class Investor. Um, we had kind of a up and then down week in the market, so it was up early and then down later in the week, and we're still in this little consolidation phase, um, which might last a little longer. It's kind of hard to say. I'm going to go down to a daily chart. Let's just look at a 6 month and let's look at this pattern a little closer. And what you see is you kind of see a down, or I'm sorry, a down, up, down, and then a up, down, up, and then a down, up, down. So this is a classic, you know, correction, sideways triangle type of correction. And usually these are made up of five waves. So this would be one. So 1, 2, 3, 4, but it didn't quite go here. So maybe, maybe this one makes it, early next week, comes up to here and then sells back off and then rallies. So it could be a triangle, or it could just be, it looks to me like a triangle, but if this fell substantially lower, below this low or this low, then it's not a triangle. It's just some sort of complex pullback. But this is almost a little too deep to rally higher from here, but I think it still could. So I think the well, there's always two possibilities, right? It goes up or it goes down, but I think the odds favor that this probably goes up to touch this area or a little bit beyond, and then falls back and then takes off. I think that's the odds. It could just fall from here and then take off, but either way, probably sometime next week we're going to break out of this triangle to the upside, and if not next week, certainly the week after that. So this could chop around, go here and then 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 here, and not make it quite out of the triangle next week, but certainly by the following week we should be out of this triangle and on our way to the upside. So I would say, if you're looking to get long the market, somewhere in here, if this just pulls back Monday, then go ahead and get in here. If it starts to drift up a little bit, wait for it to pull back and then get in down here. So hopefully that helps you guys if you're trying to manage your 401k. Now, this move is not going to be that long. It's going to last maybe a month. So make sure you can get in and out of your 401k in a month, maybe 5 weeks. But certainly this is not going to be a 3-month move. In fact, the best way to kind of estimate this move is to go back to, well, let me go back to a weekly, just so we're, go back to this one right here. This was actually quite long. But from here to here, let's see, that was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks. So it could be a little longer than a month, but I don't know. It doesn't look like it's going to take that long. If it were a deeper pullback back to this, this area here, this 2250 area, if we were to get a deeper pullback into here, then yeah, I think it could last 11 or 12 weeks. But right now, it's looking like a triangle consolidation, and once it breaks out of this triangle, it's going to run up fairly quickly to some highs there around 2450. But then we should start getting some fireworks. We should start getting some pretty significant downward pressure on the market, and that's where I want you to be careful. Let's look at the volatility. The volatility is still very, very low historically compared to historical data. And let me zoom in a little bit so I can bring this higher to the top of the screen. There we go. I mean, this whole period from July of 2016 to now has been very, very low volatility with some intermittent spikes. Probably what I need to do is extend this box out a little further, because really once it gets above this box, that's when we really want to start. That's when the market is telling us the risk is starting to pick up. As long as it's in this box or below, the risk to the downside is minimal. Now this is a backward-looking indicator. So once the market starts to move, then this moves. But in other words, this is not telling us anything other than volatility is low right now. And I know this is kind of obvious, but periods of high volatility generally follow periods of low volatility. So it sounds kind of obvious, but certainly if we get above this area, start doing this, watch out, because it probably means the market is beginning to sell off. And if that's the case, we generally don't want to be we don't want to be long equities. All right, the next one I want to look at is the bond market. It took forever to break out of this line here, as most of you know, because we've been talking about bonds in here for, I don't know, 2 years or something. So it took forever to finally break above this line, but once it did, boy, look at it. It took off. It kind of retested here, consolidated, and then took off. And so we're getting some sort of pullback here, probably into this area, maybe the midpoint of this white candle, so something like this. And then I would expect the short-term rate to go up again. And the Fed is definitely entering an interest rate increase cycle. They may not be talking about it yet, but they are definitely, with this kind of market movement on the 3-month of the 13-week Treasury, which is a 3-month Treasury, they're definitely looking toward raising interest rates. If this just kept going and the Fed couldn't raise the rates, we would have all kinds of problems. We're going to have problems anyway, but we would start to have banking problems that would cause other problems that we might not otherwise have. While we're looking at bonds, let's look at the 10-year. The 10-year is the most important interest rate in our market. So that's why we focus a lot on the 10-year. You can see here I've got this line here at this midpoint of this large white candle. A lot of times this tends to act as a support area, or the gap. The gap, we could put another line there. The gap also tends to be a support area. So what I'm looking for is this to pull back, at least close the gap, and potentially come down here to this midpoint, this 0.19 area, or excuse me, 1.9. So if you see yields start approaching, 2.1 or 1.9, you really, really need to think about getting out of your long bond fund positions. Those are really going to start losing money as soon as this starts to turn and go the other way. That is absolutely positively clear to me. I can't caution you enough about making sure that you don't have any bond funds, or when this starts to turn and go up, that you don't have any bond funds in your 401k, your IRAs, your portfolio in general. Okay? If anybody wants to ask me questions about that, just go to the comments section there on YouTube and comment, and I can reply to whatever your comments are. All right. Let's look at the international market. So Germany, Japan, United Kingdom. We've had this support area, this resistance area on here forever. So I think what we're seeing, what was actually happening is Japan and the international markets are ahead of us. So we're eventually gonna get to this area up here, and maybe it does take 12 weeks. I don't know, but I think eventually Japan is going to get, or Germany is going to make its way up into this resistance area and then roll over, probably before our market rolls over. So um, maybe it's important to keep a close eye on these. Let's look at a longer term chart here real quick. Yeah, see, this looks very corrective to me. So yeah, it looks like to me that Germany will likely roll over before the U.S. does, and it might not get all the way up to here. It might only get to just a slight new high. Let's look at Japan. I think Japan will make new high if it hasn't already. Yeah, it's already made new highs, and it's just touched our box up here, and may go further into it. But same kind of deal. It's not going to go substantially higher than this. United Kingdom, if I can get it, there we go. I think maybe the UK is in a different scenario. I think maybe it's already topped, and this is moving down. It's hard to say, but certainly doesn't look like the UK is going to make new highs here from 2014. Yeah, it's already below this support area right here, which is this right here is an important support area. And it's already traded below that. So to me, the UK is probably already topped and it's starting to roll over. Now it did make, this was a new high, and then it looked like it was going to try to make a new high here and got truncated a little bit. So it's a little unclear, but I doubt very seriously if it's going to make a new high. If it does, it'll be just slightly a new high, and then roll over fairly quickly. Let's switch over to the other charts and look at the euro. For some reason, I can't look at the dollar anymore. I don't know why. Something's changed about the symbol, and I need to probably investigate that. But the euro, has been grinding lower and then really dropped here rapidly. And you can see here that this yellow line here on the bottom of this triangle has kind of acted as resistance. So it traded down, it ran back up, kind of retested. Here, let me zoom in a little bit. It's kind of low on the, there we go. So, we ran down right here, ran back up, kind of retested those, the bottom side of that triangle. And now it's looking like it wants to go lower. Now, when it does, it's going to go, it'll make a new low lower than this low. It could be just slightly lower, or it could be substantially lower, but it will definitely take out this low. So if you want to be short the euro right now, you've got probably, let's see, what is that, 107.25 to, you got 500 pips. That's $5,000 on a standard lot. So it's pretty good cheese there if you wanted to be short the euro. I was short the euro a little bit last week on a more short-term basis, and then bought it back here and watched it rally up. So I'm waiting to enter again, and suspect the next move will be stronger. Because this is maybe, let's say this is the first move in this smaller pattern. This was your retest up, and then this next one will be stronger. So I'm looking to, get short the euro somewhere in around here, in around where it actually is. And of course, if you feel the same way I do about the euro, then you can do that yourself. There's a couple other, the British pound, had a, pretty big sell-off. it looks like it's going to start strengthening against the dollar. Um, to me, I don't know if you can see this or not. Well, problem is I don't want to zoom in, but so let me draw it like this. Maybe it'll be easier to see. This right here, from here to here to here, is a classic correction pattern. So I would say that the British pound, if you wanted to be long something, for a really long time, that should make a lot of money over a period of time. Now it's not going to go straight there. It's going to take years, probably, maybe 5 years. But you could trade the British pound in here back up to, at least this area around 2, and make just a pile of money. I don't know how much money that would be, but that's a lot of money. So, think about that one too. That's one that I spotted, and that's a very, very long-term trend. Now, if you wanted to zoom in on this, on a daily, it's right now it's probably going to pull back some because we've reached, if we're not there yet, it may make one little move higher. So this is on a daily. So we might make one little move higher here because you can see this pivot here is an important pivot. This one right here. I didn't draw that last line straight. I'm having trouble with lines today. Feel like a 4-year-old. So it's already in the zone of pullback, but it could make, it's kind of pulled back in a little zigzag. It could make one more move higher, and then you're probably going to see, the euro do something. It'll pull back to there, rally up a little bit, and then probably pull all the way back down into this area just below this pivot, because this is kind of a smaller degree important pivot. Okay, so you can kind of see a little support area right in here. So let's look to see where that is, just in case we have some people interested in trading this British pound. So maybe around 1.232, 1.232. In fact, let's put a box there, just to remind us that that's probably a pretty good entry. And long the British pound against the dollar. So that's still going to be what? I mean, that's probably 2 or 3 weeks away. So you still got plenty of time to prepare that trade. Now there's a possibility it could pull down into this area, but I don't think so. I think this is a more likely area. Now if it pulls down below this area, that might be your stop. So you have to figure out your risk accordingly on how you're going to trade this. But from a very long-term perspective, if you wanted to just buy something and hold it for a long period of time, this has got a long way to go up. It's going to take many, many, many years. We're going to see a very long-term bull market in the British pound, I think. And I'm guessing that's because the dollar's going to start losing value. We have a lot of debt. Nobody really knows how the government's going to deal with that, but this is pretty much telling us that the way they're going to deal with it is by printing money and devaluing the dollar. So this could be trade related too. I mean, it could have something to do with trade policies that are on the horizon. I don't know how the market knows this kind of stuff, and maybe it doesn't. Maybe people and everything respond to the way the market is. I mean, that's more logical, right? And so we've got a real populist movement right now where Americans are somehow being screwed by the rest of the world due to currency manipulation or trade unfairness and this, that, and the other, and that may drive the dollar lower and the British pound higher. Remember, the British pound, the British have left the euro, and it's quite conceivable that their currency would strengthen as a result of that move. And it's possible, given our debt and our populism, that our currency could weaken over the next decade or so. So this graph makes a lot of sense if you spend a little time thinking about it. All right. What other one do we can look at the US dollar JPY. This one's not as clear. So, I mean, I think the JPY, the US dollar JPY is probably going to go a little lower here. Probably see a pullback. Let's move this. Probably see something pull back into there. And then it could potentially rally. It looks like it would rally after that. So, but to me, the British pound is much more clear. So, there's other ways. Let's go back to profit charts for a second. There's other ways to invest in the British pound. So you can do a symbol search. Better way to do this is probably on Google. If I could spell British, T-I-S-H, pound. So, there's a lot of, these are all futures, and that's probably not what you want. But if you went to Google and just type in British pound, like for those of you that don't want to mess with Forex or don't have a Forex account, I'm not sure what's going on here. There we go. Okay, British pound. Sorry, I'm typing slow. British pound ETF. That's what we want to type in. So you can scroll down here. Top 2 British pound ETFs. Okay, so let's see what those are. Got a little advertisement we got to get rid of. Sorry about all this dead air. Okay, so looking for, okay, here they are. FXB and GBB. Okay, so let me show you how we determine which one we want to look at. Look at it one more time. What was it? FXB and GBB. FXB. So just type in FXB just like you're typing in a stock. And what I want to do is I want to go over here to, I want to put my volume on. I've got it hidden right now. So the FXB looks like the average is about 2.5 million shares a day. That's pretty highly traded. So that, to me, that looks good. The other one was GBB. So let me see how many GBB. You want to trade, see the volume is only in the average is maybe 50,000 shares a day. So what I would do if you wanted to get involved in being long the British pound, then I would look at the FXB. And so let's just look at that from a stock standpoint. Because to me this looks, wait, let me see if I'm on a weekly. I think I'm on a weekly. Sorry about that. I fat fingered something. Okay, now I'm on a monthly. So let's look at a daily. Let's look at a 9-month because that's the low. See, the low's right here. So let's analyze this just a little bit and try to see what we can see here. So we have this low right here. Okay. So I'm going to draw a line underneath it like so. And we know this is a very long-term low. This is not only a weekly low, but it was a monthly low. So you have to go back months and months and months. There was no low lower than this low. So what happened? We ran up from here, okay, and we pulled back. So what's actually happening here? We had some sort of 5-wave move up, some sort of correction back, and now we're starting a new 5-wave move. Okay, so I know it doesn't look like it. It looks like a correction at this point, but we do have an important low here. Okay, so we know that this is the first move off the low. We pull back to a higher low. So this low here is higher than this low. Okay. So what does that mean? Well, that means this is at least a C. So it could be just a C, and then it pulls back from here and makes a new low. So what we want to do, if we're looking to get into this, is we want to say, okay, where are the likely points of pullback? So this is a very likely point, to close the gap. And then something just below this pivot low is also likely, although at this point may be less likely. So I would say this area is very likely, and it might not quite close the gap because see we have this high here, and this high is slightly higher than this gap. So we might get a pullback maybe to here, and this might be a good entry area, and then look to be long. Okay. Now if it pulls back, if you enter and it doesn't start going up pretty quickly, and actually pulls back further, then go ahead and stop out, wait and see what it does, see if it pulls back to this low, and then buy as it moves off this low. If it runs up and then pulls back again, then just go to the next low. And then, so it may take you several times to get a good entry into this position, but that's the way trading is. You have to start with some sort of hypothesis. The hypothesis I'm making here is this is an important low. Very, very important low. And I'll go back and show you why that is in a second. So we've had a run up off this low and a pullback that looks very corrective, okay? That tells me this is the start potentially of a new trend. So let's go back, let's talk about why that's an important low. Let's go back to a monthly chart. Okay? So the British pound has been pulling back since what? 07, okay, for 10 years. And this low right here, this is the most recent low. Now it doesn't mean it's the low, it just means it's an important low. Okay, there's price action that came after this low. We ran up, we pulled back, we ran up. So far from this low forward, this is the lowest low. There is no this low is not lower, this low is not lower, this low is not lower. So this is an important low. So let me highlight it. Okay, so it's not just an important low on a monthly chart. It's also, if you go to a weekly, it's also an important low there. See, many weeks have passed. Here's that low, and for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. For 14 weeks, this low is held. And in between there, we made a higher low and took off again. So this is an important low. Okay, that's all I'm saying. This is our anchor point. All of our analysis starts with here. You don't change your analysis unless you make a newer low. Okay, so that's how I've arrived at this is potentially a good investment. Now look, your money's your money. You decide what to do with your money. But I'm just here trying to point out some good low risk long-term entries, because you're going to need some alternatives when the market sells off, right? When the market's been in a bull run for 10 years, it's not going up for another 10. So you want to have some investments that can go up while the market's going down. And there's a lot of value here in this FXB. So in fact, I'm going to save it, and we're going to look at it periodically just to check it. All right, let's go back to our other chart system and look at gold. Just make some adjustments here. We typically look at gold. Gold, is in probably a very long-term bull market. In fact, in the same context, let's just think about this in the same context that we were just talking about the British pound. This back here is an important low at $253. If you go back before this, gold ran up to a high of like 700 and something and pulled all the way back to here, okay? And ran up for 12 years, okay? So this is a new bull market in gold. Yes, it's been down since 2011. That's true. So markets don't, they wax and wane, right? They go up and they pull back and then they go up, okay? So it all depends on the time frame you're looking at. So gold, in my mind, is a very long-term kind of deal. And so what you want to do, in other words, you can trade gold very short-term, but gold is not an investment. Gold is more of a hedge against currency and things like that. So therefore, it makes it kind of a long-term, potentially long-term investment. So what you want to do is you want to enter places where the reward is high and the risk is very low. So if this is the first move off this important low, then what we should be expecting is a pullback, okay? Some sort of pullback in gold. So with that in mind, let's zoom in on this area. And so your pullback is going to look something like, and we'll go back and look at the British pound too. It's going to look something like, maybe it could stop there, or it could go a little higher, maybe to around 1600, or maybe just under 1600 right there. And then you're going to see a pretty substantial pullback like that. And I've got this box down here because of this low that's back here. So let me put that in there. Make it level. There we go. So that's why this box is here, is because this important pivot right here is the fourth wave low off this long bull market move. Okay, so we're going to look for gold to pull all the way back into here. So when this starts pulling back further and further and further, you're going to hear me start talking about buying gold, and I'm not talking about buying GLD, although you could do that, but I'm talking about buying physical gold or silver when we get something this deep back in here. Right here, all this stuff, when I'm talking about buying gold, this is a good entry for gold. I mean, yeah, you could buy gold bullion here or coins or whatever, but this is really more of a trade. I mean, right now you could be long gold, and I would expect you to at least trade to there, which is around $1,500, okay, before this particular correction stalls and starts to roll over. Now, notice this down, up, down, and then I'm going to go back to the British pound, and I want you to look at it there. Okay, so just briefly here, I'm going to go back to the British pound. You see that? Down, up, down. And if we were to scrunch this up and really look at the British pound over, well, I don't know if I can't go, but the British pound was low for a long time and ran all the way up to here, and then had this pullback. So what we expect is whatever this trend was here before, which was goes way back, and British government's been around for a long time. The British pound's been around for a long time. So we would expect this bull market then, after this huge correction, to continue. And just so you know, again, it doesn't go straight up. This is an important pivot. So this is going to stop out a lot of long traders here. So it's really more like, to here and then back. I'm sorry I'm spending a lot of time. Hopefully this is helpful. And then back in some sort of, like so. Now we're off the chart here. And then up, okay? And then up. So maybe maybe for the purpose of this this trading room or whatever, we say that the British pound would be a good trade, long term and intermediate term, to there. Maybe that's what we do, just beyond this pivot right here. In fact, when it gets to this point, which is 1.72, you sell your position and you wait for a pullback. Okay, that doesn't mean it stops there. It could actually go a little higher. but you should wait for a pullback. Because the risk starts to pick up right here, and you want to capture your profits and hang on to them. So anyway, hopefully you see this pattern, and when we go look at gold, you can see that that's what we're expecting to see here too. You know, a down, up, down. Okay. Hopefully that helps out. So I'm not going to look at silver. Silver it's similar. I mean, we're looking for silver to move up to here and then maybe a leg higher. But that's really about it. The bigger focus near term, okay? So near term means like, you know, over the next several weeks, next month and a half. The bigger focus is this 10-year Treasury. So I want everybody to. So let's look at this. This was an important low. So let's pull up, let's say, all data on 10-year Treasury. Okay, so this is 1981. We went to a high of 16% on the 10-year Treasury, and we've been pulling back ever since. Okay. So let's fast forward a little bit. This was in a low. So you can see back here in 2009, I'd marked this as a low. This is not in the right spot. It may just be the scale. Okay, so I know what I was doing. That March 2000. That's the low in the market. So here's the low in the bond market. This was the low in the stock market. So this was an important low, right? So I was looking at this, and then we pulled back, but then it made a lower low. So this is no longer an important low. Okay, it pulled back, made a lower low. So now this is the important low. It ran up. It's been pulling back ever since. And lo and behold, made another low. Okay, so this is the way investing can be sometimes. You think, okay, this is the low, I'm going to go long, and it rolls over. Maybe you get out somewhere in here, but then it rallies back and then makes a lower low, and you go, well, that wasn't the low. And now this is the low, so maybe you get in right here. It runs up, you make some good money, it starts to roll over, you sell. So you made money, but it's not taking off like you thought. So you sell in here, and lo and behold, it pulls back and makes another low, a lower low. So let me mark this now as the new important low. Okay. So now we've got a new low right here, and we've had this run up. Okay. And now we're getting a pullback that looks very corrective. So the areas we've talked about are the midpoint. Well, there's a smaller. This is the larger time frame. That's another thing. You got to keep an eye on these larger time frames and don't get focused on the short time frames, because sometimes support in a longer time frame will end up being the support. So, for example, let me. I think this is important, so I'm going to show you this. So this 1.9 was the midpoint of a lower time frame large candle, but this is the higher time frame midpoint of a large white candle. Okay, so now let's zoom back in to the weekly. Let me get all data off there. 5-year. So now see the midpoint. Remember I marked this on the higher time frame monthly chart. The midpoint of the large monthly candle is the gap close on the weekly, which tells me probably this line right here is going to hold. So we may see the 10-year Treasury yield pull back even lower next week, but maybe more likely now this line will actually hold. It might get a wick. Okay, you might get something like. See, to me this is really exciting, because this is the only way to me the market makes sense. But other people. Let's say next week, other people do all this fundamental analysis, and to me it just doesn't. So maybe next week is like this, and then maybe the following week is like this. So you get a tail that actually goes down lower, so that the market trades lower, but the open and close are above this line. And then the telltale is going to be, maybe the following week you get a close above the high of this weekly candle, and then probably from there it's off to the races. And the Fed's going to just re-raising, and they're not going to, once this gets going, they're not going to raise just a quarter of a point. They're going to start raising, a half a point, a point. I mean, they're going to be substantial raises going forward. It's not going to be this, oh, we're going to raise a quarter of a point. They're going to really start raising. So, and that's going to have a damaging effect on the market. So keep an eye. This is so super important. A 2% move in yield, so from 2.2 to 4.2, could wipe out 50% of your bond position. Okay, in your 401k. So don't mess around with this. This is very, very serious. All right. On that note, I think I'm going to shut down this week. Talked for a long time. You can go to @InvestorClass on Twitter, or look up Middle Class Investor. You can say, Seth, you're full of crap, or something like that, or you're whatever you want to say there, or you can comment on the YouTube channel. All right. Thanks everybody for coming in. We'll talk to you next week. Bye-bye.